here's the problem with high acquisition fees. They create an incentive to just do deals. If a sponsor is collecting 4 or 5% every time they close an acquisition, the act of closing becomes a profitable business entirely on its own. This is whether the deal works or doesn't work. That's a business model built on closing, not on performing on the actual deal. And when a sponsor is incentivized to do deals, the quality filter starts to change. The bar for what counts as a good deal starts getting lower because every deal that closes is revenue for the sponsor, even if it's mediocre for the investor. Over the last 3 videos, we've covered a lot of ground. We talked about why wealthy investors allocate to alternatives in the first place. We broke down preferred returns, what they actually mean, and where they can mislead you. And then we went deep on waterfalls, the full structure that determines who gets paid, when, and in what order. But here's what I didn't mention. All of that, the pref, the waterfall, the carry, the split, that's how profits get distributed on the back end and during the hold period. There's a whole other layer that happens before any of that. And it's the part most investors don't spend nearly enough time on: fees. Not in the fees are bad sense. I'm not here to tell you that sponsors shouldn't get paid at all. They absolutely should. Running a deal takes meaningful work, real overhead, and real risk they're taking on. But the way fees are structured, how many there are, what they're based on, when they're charged, that's where alignment either shows up or it totally falls apart. Today, I'm focusing specifically on real estate syndications because that's where most passive investors start. It's where the fee structures tend to have the most layers, and it's where I have the most experience personally. I've now invested in over 70 different real estate syndications at this point, and after looking at that many fee structures, you start to notice a few things. The first one is the asset management fees. This is one most people have heard of. It's the ongoing fee the sponsor charges for managing investment, typically 1 to 2% per year. Here's what I pay attention to: the basis, what the fees actually calculated on. In real estate syndications, asset management fees are typically based on one of two things. Either 1, the capital invested into the deal, or 2, the effective gross income. And those numbers are very, very different, and they move differently over time. A 1% fee on $10 million invested capital is $100,000 per year. That number is fixed. It doesn't change unless the capital structure itself changes. A fee based on EGI, or effective gross income, fluctuates with the property's performance. As the sponsor executes business plan and rents increase, the EGI grows, and so does that fee every single year. That's not necessarily a bad thing. It can actually create alignment with the sponsor's growing income. But it's worth understanding because your fee load is not static. It's going up over time if that deal performs, and down if it doesn't. Neither one's actually wrong, but you should know which one you're in. And it's not always obvious from the summary page. This is the big one: acquisition fees. This is where I have some stronger opinions, to say the least. The sponsor charges a fee for finding, underwriting, and closing the deal. In most syndications, this fee runs anywhere from 1% to 3% of the purchase price, but I've seen some as high as 5%. At 1 to 2%, I can usually understand the justification. The sponsor sourced the deal, negotiated the terms, coordinated diligence, arranged financing. That's legitimate work. At 3 to 5%, I need to see some serious justification. Are they finding assets that are massively discounted? Are they sourcing off-market deals through proprietary relationships? Is there a genuine competitive advantage in how they're accessing deals? Because here's the problem with high acquisition fees. They create an incentive to just do deals. If a sponsor is collecting 4 or 5% every time they close an acquisition, the act of closing becomes a profitable business entirely on its own. This is whether the deal works or doesn't work. That's a business model built on closing, not on performing on the actual deal. And when a sponsor is incentivized to do deals, the quality filter starts to change. The bar for what counts as a good deal starts getting lower because every deal that closes is revenue for the sponsor, even if it's mediocre for the investor. That doesn't mean every sponsor with a 4% acquisition fee is doing this, but the structure will allow for it. And the structure is what I pay attention to. The other thing to note is that acquisition fees are paid upfront, usually out of the capital that you invest. So on a $100,000 investment with 3% acquisition fee, this comes off before a single dollar is deployed into the deal. Make your money from $97,000 from day one. But here's the part most people miss. The acquisition fee is actually based off the purchase price of the asset, not off the equity raised. So think about what this means with leverage. Say that sponsor is buying a deal for $10 million and they put 6% leverage in that property. That means $6 million of debt, $4 million of equity. So 3% acquisition fee on $10 million is $300,000. That's coming out of the $4 million in equity. That's not 30% of your money. That's 7.5%. The headline says 3%. The reality, relative to equity you actually invested, is more than double that. And the more leverage in the deal, that wider that gap actually gets. At a 5% acquisition fee on a leveraged deal, you could be looking at 12% or more of the total equity going to the fee just on day one. That's a massive hole to dig out of, even before the deal starts producing returns. This is one of those things that's technically in the documents, but almost never framed this way in a pitch deck, and it changes the math more than most investors realize. Disposition fees. This one shows up at the other end of the deal, when the asset is sold. Some sponsors charge a fee, typically 1 to 2% of the sale price for managing the exit. So I'll be direct. I've never loved this one. And here's why. You're investing in a deal with an expected exit. The whole business plan is built around buying something, improving it, and then in turn selling it at a higher price. Exiting the asset is the exact job of a deal. It's not some extra service, it's the exact plan you're paying for already. If a sponsor wants to charge a disposition fee, I think it should be tied to performance. Did they hit or exceed the exit plan they projected? Fine. There's an argument for rewarding a well-executed sale. But a flat fee for selling something you were always supposed to sell, that feels like a toll booth on a highway you were already driving on. Some sponsors will push back and say the exit process is complex. Broker coordination, buyer negotiations, closing logistics. And yes, that's true, but complexity is already built in to the promote structure. The carry is reward for a good outcome. A disposition fee on top of that is essentially double dipping. Not every sponsor charges one. The ones who don't are making a statement about alignment. And I noticed that. Legal and organizational costs. This one I feel pretty clearly about. Legal and organizational costs, the PPM, the operating agreement, entity formation, compliance setup, these are real expenses that every deal has. But they should be a direct pass-through to the deal as an expense, not an additional fee. The difference matters. An expense is a cost, the sponsor pays the attorney, and that cost is reflected in the deal's budget. A fee is a revenue line for the sponsor, and sometimes that fee is actually higher than the legal cost itself. When I see legal costs structured as a fee with a markup, it tells me the sponsor is looking for revenue in places where there should not be margin. This is a very clear signal. The best operators I've worked with treat legal costs as what they are, a cost of doing business that gets passed through at cost. Construction and development management fees. In a value add or development deal, you'll sometimes see a separate fee for overseeing the construction renovation, usually 3 to 5% of the total project cost. This one is totally context dependent. If the sponsor has an in-house team genuinely managing a $5 million renovation, coordinating contractors, managing timelines, handling permitting, dealing with change orders, that's meaningful work, and a management fee there is reasonable. But if they're outsourcing the entire project to a third-party construction manager and still charging you 5%, that fee is pure margin, not payment for actual work. That's worth a conversation and a second look. The key question is, who is actually doing the work? If the sponsor has boots on the ground, that fee is reasonable. If they're essentially acting as a pass-through and taking a percentage for doing so, that's totally different. Now, let me show you something that I think is the most important concept in this entire video. There's a number that sponsors talk about, and there's a different number that you actually experience. Most investors don't realize those are two different things. The pitch deck may say 18% IRR and 2x equity multiple. Those numbers might be real, but the underwriting might be solid. The deal might actually produce those returns at the deal level. Deal level returns are the returns of the asset itself. It's what the property generates before any fees, promotes, structural costs, before those are all taken out. Think of that as the raw performance of the real estate itself. Investor level returns are what's left after everything else is deducted. Acquisition fee, asset management fees, disposition fees, legal costs, promote. That's the number that actually shows in your account at the end of the day. And the gap between those two numbers is actually wider than you may think. Let me put real numbers to this. Say you invest $200,000 into syndication, 5-year hold period. The sponsor underwrites the deal to an 18% IRR and a 2x equity multiple at the deal level. The property is purchased for $5 million with 60% leverage. So the total equity raise is $2 million, and your $200,000 is 10% of that. Now, let's layer in the fee structure. 3% acquisition fee on $5 million purchase price. That's $150 in total, and your pro rata share is $15,000. Remember, that's 7.5% of your equity, not 3%. So your working capital in the deal is $185,000 from day one. Now, insert a 1.5% annual asset management fee on invested equity. That's $3,000 per year or $15,000 over 5 years. And there's a 1% dispo fee at exit. If the property sells exactly where you're projecting, your share of that is $2,000. legal, and organizational pass-through costs. Maybe your share is $1,000. So that's $33,000 in fees on your $200,000 investment, or about 16.5% of your original capital. And none of that includes the promote. The promote is the sponsor's share of profits above the preferred return. And this is on top of all the fees. If the deal hits numbers, the sponsor will earn 20% of the profits above the 8% hurdle. That's another meaningful slice before coming out of your full return. So that 18% deal level IRR, by the time you subtract fees, promote, the fact that your working capital was meaningful lower at 185,000 versus 200K, your investor level IRR might be closer to a 12 or a 13, maybe less. That's a 5 to 6% gap between what the pitch deck says and what you actually experience. On a $200,000 investment over 5 years, that's a meaningful difference in terms of real dollars. Now, does the deal still work at 12%, 30% net IRR? For a lot of investors, sure. That's still a solid return. But the investor needs to know the numbers they're actually evaluating, not the 18%. Now, the deal still has to hit its projections. The underwriting still has to be solid, but it has to hit those projections just to deliver a reasonable net return. There's less margin for error. If the deal underperforms, even by a few percent at the asset level, the investor returns compress extremely fast because the fees are fixed. They don't go down when the deal underperforms. Now, if you're comparing two syndications side by side, one shows an 18% IRR and the other one shows a 15%. The instinct is to go the higher number. But if the 18% deal has a heavier fee load and the 15% deal is leaner, the net returns may actually be similar, or the 15% deal may actually be better. That's why you have to look at this at an investor level, not the deal level. And most pitch decks don't make it that easy. So how do you actually evaluate fee structures? I don't think the goal is to find deals with the lowest fees. That's the wrong filter. After 70 plus syndications myself, some of the best operators I've worked with charge full fees, and they're worth every dollar because the execution is excellent and the alignment is extremely real. The goal is to understand what it is that you're paying for, why you're paying it, and whether the fee structure creates the right incentives for the operator and for you as the investor. Here's what I looked at. 1, where does the sponsor's income actually come from? This is the most important question, and I mean it literally. If you look at a sponsor's P&L, what percent of their total earnings come from guaranteed fees versus what percentage comes from performance? A sponsor who makes the bulk of their income from asset management fees and acquisition fees has a business model that works whether or not the deal performs for you. The fee clock starts ticking the moment you wire your capital. They're incentivized to go raise equity and close deals, not necessarily maximize returns. A sponsor makes the bulk of their income from the promote, from their share of profits above the preferred return, only gets paid when you do well. Their biggest payday comes from performance, not from just closing the deal. Now, most sponsors need some kind of management fee to cover overhead. Salaries, office space, accounting, legal, that's all very real. I'm not saying fees should be zero, but the ratio matters a ton. If the fee income alone is enough to run a very comfortable business, then the promote becomes a bonus, not the actual goal. When the promote is a bonus, the urgency to perform for investors totally changes. The hunger is different. Compare that to where the sponsor, their upside is totally tied to the promote. These operators wake up every morning thinking about how to maximize the exit value because that's where their income actually comes from. The fees keep the lights on. The promote is the actual business model itself. That's the alignment that I want as an investor. 2, are the fees proportional to the actual work they're doing? A 2% acquisition fee on a deal where the sponsor sourced a deal off market, negotiated directly, structured creatively, that's really fair. A 2% acquisition fee on a deal that's been listed, went through a broker process, I want to understand what it is that I'm actually paying for. And the same goes for construction management fees. If the sponsor has the in-house team actually running the renovation, paying a 4 or 5% fee covers real people doing real work. If they're passing it off to a third-party general contractor and taking points on that, that doesn't feel like the same thing. I'm not saying either is a deal breaker. I'm saying the conversation truly matters. 3, how transparent is the sponsor when you ask about fees? When I'm evaluating a deal and I ask about the entire fee structure, not just what's in that tiny summary page, but everything, how does a sponsor respond? This is crucial. The best operators walk you through it without hesitation. They'll show you exactly where every dollar goes. Some of them even include a fee schedule in their materials that breaks out every single line item, the basis and the timing of them. A sponsor who gets defensive when you ask about fees is telling you something. Maybe that not the fees are bad, but at a minimum, they're not comfortable talking about it. And in private markets where everything is built on trust and transparency, that tells you a lot. 4, what's the total fee load relative to the total return? Now, this ties it all together. Add up every fee over the hold period and compare it to the total net return. If the fees represent 8 to 12 to 14% of your total capital invested in a deal, projecting 18%, I'd call that normal within a range for syndication. Not cheap, but the math can still work that deal performs. If total fees are 15, 16, 20%, I want to see exceptional execution or proprietary access that actually justifies it. Otherwise, the fee structure is eating way too much into the return of the deal. The deal has to significantly outperform just to get you to a reasonable net outcome. And remember what we just talked about. Fees don't go down when the deal underperforms. They're already collected. That fee load becomes a bigger percentage of a therefore smaller pie. Before I close, let me give you 5 questions you can take into any real estate syndication. 1, what is the total fee load over the lifetime of the investment? Not one fee at a time, all of them added up. Acquisition fees, dispo fees, refinance fees, legal fees, construction fees, everything at once. 2, what's the fee basis? Is the asset management fee based on invested capital or effective gross income? Is it fixed or does it grow if the property performs? The basis matters more than the percentage does itself. 3, how much of the sponsor's money comes from fees versus the promote? You want to know where their business model actually lives. If fees alone make them comfortable, the incentive to perform is totally different, right? If they're making 80% of the money from fees, 20 on promote, those should be flip-flopped. 4, are there any fees paid regardless of performance? If the deal returns 0, if the property loses value and you get back less than you put into it, what has the sponsor still collected? That number tells you a lot about how the risk is distributed. 5, can the sponsor walk me through every fee clearly without getting defensive? You don't need to go ask these in an adversarial way. The best conversations I've had with sponsors started with, hey, help me understand your fee structure. That's it. How they respond tells you most of what you need to know. Here's the thing about fees. They're not necessarily the enemy. A good sponsor should get paid, and a well-structured fee arrangement is part of a healthy deal. The work is real. The overhead is real. But fee structures are where alignment either shows up or totally falls apart. 2 syndications can have the exact same projected return, the same preferred return, the same waterfall, and deliver very different outcomes to you based on how those fees are structured. The deal level return is what the asset produces by itself. The investor level return is what you actually keep. And the gap between those 2 numbers is where you spend your time. If you've been watching the series, you now have a foundation that most passive investors never built. You understand why capital is allocated to alternatives. You understand how priority actually works. You understand how incentives are actually structured. And now you understand where the sponsor makes money before the waterfall even kicks in. But here's the thing. Fees don't exist in a vacuum. The way you're taxed on those investments changes what you actually keep and more than the fees you do. And for high earners, tax strategy isn't optional. It's there between a good return and a great one. That's what we're covering next. I'll see you there.